Daily Fiscal Pulse for the 4th of August, 2026. Just a heads up that what you're hearing is a look back. All the data we're covering reflects positions through the close of business Tuesday. Let's start by getting oriented on what's capturing market attention right now. The story so far hasn't crystallized around any single dominant narrative. You're seeing headlines move on Iran and Oman signaling that Strait of Hormuz negotiations are heading into their final stretch, with Trump continuing to dangle the prospect of a deal announcement. That's clearly having an effect on price action. But let's set aside the headlines for a moment and look at what the actual flow of capital is telling us. Once we get into the numbers, we see net fiscal transfer landed at $5.5 billion. Tax receipts came in as the primary contributor, delivering $5.9 billion to the flow. On the surface, nothing jumps out as abnormal. What's interesting is how price has held its ground. ES futures wrapped the session at 7,764, sitting comfortably above the 20-day moving average of 7,535. Over a 20-day window, we're looking at a trading range of roughly 440 points. So equities have managed to stay supported even as fiscal flows have been restraining. Some longer-term perspective helps clarify the picture. When we look at the 5-day average for government spending, we're tracking about $27.9 billion per day. Now stack that against the 20-day average sitting around $11.7 billion. That's a meaningful gap, which means more dollars are flowing through to households and from there into financial markets. Year over year tells a similar story. Spending on a fiscal year-to-date basis has reached $1,460.3 billion, which represents roughly a 13% decline versus the same stretch last year. It's a material pullback in fiscal support, and that does have consequences for how much liquidity is sloshing through the system. From a tactical standpoint, the fiscal backdrop isn't handing you a clear directional advantage at the moment. Our conditions gauge is sitting at -11, but context matters here. We've encountered this exact type of environment on multiple occasions before, and what we've observed is that despite tighter liquidity, the S&P has still managed to post gains averaging around positive 0.8% in the month that follows. Equities don't necessarily track liquidity in a linear fashion. They can and frequently do work higher regardless. There's also a positioning dimension worth flagging. Leveraged fund buying has continued to ramp. Meanwhile, margin debt has climbed to the 100th percentile. That's stretched territory. Historically, when we reach those kinds of levels, they function more as a caution signal than a reason to feel bullish. Looking ahead at the calendar, a couple of dates deserve attention. The 12th of August is when the SSA payment cycle rolls through, the second Wednesday of the month, and shifts like that can shuffle around near-term flows. Beyond that, the next substantial Treasury coupon interest payout window opens up around the 15th of August. At present, we're not getting a strong fiscal signal pointing in either direction. The flows that are scheduled to come will be what tips the scales one way or the other. That's where the positioning edge sits for now.